Hi everyone, I'm Sophie from InvestSMART and joining me today is our portfolio manager Nathan Bell. He'll be discussing some opportunities for the growth and income portfolios. Nathan will also be answering any of your questions at the end of the webinar, so please feel free to send through any you may have as we go along today. And I'll now hand you over to Nathan.
Thank you, Sophie, and welcome everyone. I think over the next few years, it's going to be a lot tougher in the markets than what it's been over the last few. So we're not always going to be able to start on a bright note, but we really can this morning as we woke to the news that TradeMe, which is the largest position in both our growth and income portfolios, has received a non-binding takeover offer at about a 30% premium to the stock price. So it's a really good news, and also well done to James Carlo, who's stuck with the stock for many years, including when I was back at Intelligent Investor. But I just thought it's also a really good lesson in that if you buy well, the value's there, you don't always get the returns straight away. Sometimes you have to really hang in there, and it's always why our returns are probably going to be lumpier at times than the market returns. But that's the price you have to pay for higher long-term returns than the index. And as Warren Buffett said, he'd much rather a lumpy 13% return than a straight, consistent 10% return. So it's a really good start, and I was actually going to talk about TradeMe today, so it's actually a good segue into our presentation. I'm going to do these webinars on a quarterly basis, and in the future they'll be more structured around the portfolio holdings and the recent performance and what's going on in markets. But because for many of you aren't familiar with me, this is the first time you've had anything to do with me, I really wanted to go through what the overall process is that I'm using to look for opportunities, rather than focusing on the recent quarters or the recent results or the stocks in the portfolio, particularly the bigger ones. And so if you do have questions about any of that sort of stuff, please submit them. I'm going to try and keep the presentation today to 25 or 30 minutes. As always, I've got too many slides, so I'll have to flick through a few of them quickly. But I really just want you, I guess in this first instance of our webinars, I just want you to have a good understanding of how we're going about it. And there's no real change to anything that I did at Intelligent Investor 10 years ago. It's the same process, but I've just found along the way that there's a few specific things that I wouldn't have paid as much attention to in the past as I do these days. And I think that's where we're going to find opportunities in a market that's going to be much tougher, because what we're seeing now, I mean, this volatility, which is really a euphemism for falling share prices, is a lot has to do with, it's just price to earnings compression. We've seen some stocks just trading on these massive price to earnings multiples, and now we're starting to see that in reverse. So we can't just rely on someone willing to pay higher valuations for our stocks. We really need the operating performance of our businesses to justify the valuations. So with that, I'm just going to flick through a couple of quick slides here as a disclaimer there. So as always, this is only, please only consider this general advice. There's a little bit of background about InvestSMART, but I'm going to assume everyone on here this morning is familiar with InvestSMART. And this slide is a summary of what I'm going to take you through over the next 20 or 25 minutes. So I first want to talk about how we're going to find high quality businesses in an expensive market, and a few of the things we're looking for that you'll be very familiar with. We're looking for that high insider ownership for reasons I'll spell out. We've got long growth runways. This is part of the reason why the healthcare stocks are so good and why CSL is so good. It's just been able to grow so strongly for such a long period. And as always, we're cheapskates, so we're looking for 50 cent dollars where possible. And then I'm going to take you through a bunch of special situations, which when a new CEO comes to a business, so AMP's a good upcoming example of that. Going to look at an example of a company that's been recapitalized and why I'm focusing on that as well. We're going to look at something which is more of a US phenomenon called spin-offs, but we're starting to see more of those in Australia. And they have a wonderful history of producing outsized returns. So I want to show you a couple of charts on that. And then lastly, I'm just going to provide one example of a company with hidden assets. And these take a lot of work to find, and you don't find them very often. But if you're sitting there with your computer screen or Capital IQ as we use, and you're a value investor and you're looking for very high quality businesses trading at a discount so you can put in all your criteria, what I want to show you is something that these systems cannot find. And so this is why they don't, these sorts of companies don't often get priced well, which is our opportunity. So the first is we're looking for high quality businesses. And I want to talk to you about a company that may be very familiar to you if you've been a long time Intelligent Investor subscriber. But first, I just want to mention this slide, and I think this is really, really important because at the moment, if all you're doing is reading the news and the headlines, all you're seeing is negative stuff. We're talking about the housing markets rolling over, the increased volatility in the US stock markets, which leads to the rest of the markets around the world. We're getting quantitative tightening now, which is essentially driving money out of riskier areas like emerging markets, which we've seen huge falls in over the last 6 to 12 months. The Chinese market's down around 20 or 30% in the last year. You can imagine what the headlines would look like in Australia if we saw our share market fall by that much. But through all of that, I just really want you to focus on the individual stocks that we own, which is how it's what we spend all our time doing at Intelligent Investor and InvestSMART. But I just want you to remember this quote because I feel in some ways really dumb because the first book that I got given by my former boss, Greg Hoffman, when I joined, was a book by this guy, Peter Lynch, One Up on Wall Street. And you read the book and you've just got in starting out as a professional analyst. And it seems so simple and easy that you straight away want to get onto more complicated books to show everyone that actually you've learned a lot, you want to share that knowledge and you want to show that you can really add something. And now, maybe there's a bit of bull market talking in this, but I look back over my last 10, 13 years in the business and I find myself just seeing the real value in these quotes by Peter Lynch. And this is one I think is really important to us right now. And he says, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. And basically what he's telling you is if you buy the right companies, they're going to continue to grow and add value through the cycle. So I'm seeing articles increasingly this week. There's another one this morning in the AFR, Goldman Sachs telling people to have more cash in their portfolios. And that may well be the right decision, but I haven't met anyone yet who can time economic cycles consistently and make money. And if you look at the BRW Rich List every year, the people at the top of it are generally people who have had all their money invested in one company and they've just owned that shareholding for decades. And so essentially that's what we're trying to replicate in a portfolio with 20 stocks. So this is an example, and again, I just want you to really focus on what we're doing here, which is trying to buy individual businesses that are going to provide great returns in the future. Forget about the macro and interest rates and all these sort of things, because the good businesses bought right are going to provide the returns regardless. It's only the timing that's uncertain. So this is a company called ARB Corporation or ARB Corporation. If you've never heard of it, it's a four-wheel drive accessories company. And back in 2007, 2008, as right before the GFC, we were recommending this stock. And if you have a look at the chart there, I've shown what the absolute worst time is that you could have bought this stock prior to the GFC. So the absolute highest price right before the GFC, which everyone regards as basically the greatest recession since the Great Depression. And so no one would argue it was the worst time to buy stocks. Now, if you bought that company at that high price, so remember it got cheaper, as you can see in the chart, into the GFC, you would have earned an 18.7% annualized return since then. So that's going through one of the worst economic fiascos we've ever had in history, and you still made nearly 20% return. What's really amazing to me is I remember Gareth Brown was the analyst for the stock, and it was one of the first stocks I was introduced to when I joined Intelligent Investor. It was always on our buy list, and it ticked every box we could come up with. We thought it was cheap. It had insider ownership, which is something I'm going to come back to shortly. It had unbelievable financials, huge return on equity. It was paid fully franked dividends regularly. It paid special fully franked dividends regularly. It had everything that a stock owner could want. And yet here was this stock trading cheaply. And you ask, why on earth would the market? So if you actually think about the long-term returns of the Australian market, it's around 8 to 9%. So why on earth would the market get things so wrong that would afford you the opportunity to earn twice that in one of the safest and most highest quality businesses on the ASX? And the reason was high oil prices. Everyone was just thinking that over the next 12 months, high oil prices would dent the demand for four-wheel drive accessories and four-wheel drives themselves. Now, as you can see, that was completely ridiculous. The long-term value that this company has created has been huge. It's been an incredible performer. And so I just want to make the point that we are in a very expensive market still. We're starting to see the heat come out of some of those really high-priced stocks now. But we're not trying to buy the market. All we're trying to buy is 20 undervalued, very high quality businesses that are facing usually temporary issues that we can hold for a long, long time to come. And the longer we can hold them, then the less tax consequences we're going to have and the higher your returns are going to be. So just because the market's expensive doesn't mean we can't find these sorts of opportunities. And I guarantee you, when I come back here in 10 years' time and I look back at this period that we're in right now, we'll be able to go through another whole bunch of examples, just like ARB Corporation. And you may say, I've just cherry-picked ARB, but actually if you went to the US and looked at Australian stocks, there's absolutely hundreds of great quality businesses experienced something very similar. CSL is another example. Basically, the share price went nowhere for 4 years up until about 2010. And I was the first analyst at II that recommended it around $33. And I thought if it got to $40 in a reasonable period, that would have been a pretty good outcome. And here it is 10 years later, it's gone up about 7 times or 8 times there at one point. And it just shows you if you can find these unloved but very high quality businesses, you can really change your financial life. So another one, just a segue going from that company, is 2 companies I want to very quickly talk about, TradeMe and Seek. So these are both online classifieds businesses. Seek is the jobs business and TradeMe is essentially like car sales, Seek and REA Group, all in one, and eBay as well. And as I said earlier, we've got a non-binding bid, so there's actually a long way to go. It doesn't guarantee this company is going to go off the boards anytime soon. But the point I wanted to make is these don't look typically cheap if you look at the statistics. TradeMe is the one I'll focus on this morning, just due to time, but it was trading on around 19 times earnings, which doesn't tell you that it's particularly cheap. But the profits of this business have been held back over the last few years as the company's had to reinvest a lot of money in the business to fend off competition from the likes of Facebook. It's had to add more staff, and it's only really been in the last 6 months that we start to see that translate into better financial performance. We see some really good profit numbers coming out in the last result. And what you saw was, and it's actually somewhat surprising, REA Group or realestate.com.au, as we know, has done a really, really great job with display advertising, where it's essentially got agents competing against each other and bidding up those prices to distinguish their ads. Now, TradeMe is about 3 or 4, maybe 5 years behind on this, which, as I said, is somewhat surprising. But now you're actually starting to see that display advertising really flow through into the profits. So we're seeing very small increases in listings, but actually there's like 12 and 14% increases in revenues. So that was only just starting to kick in, but it's taken 2 or 3 years of investment to get to that point. And so I decided when I came on that I thought this was still a very good idea, and I kept it as the largest stock in our portfolio, and now we've got a bid for it. So again, I just make the point that you can find value in these markets, and we're not just looking for the cheapest stocks or with the lowest price to earnings ratios. We're looking for companies that have real value that we think is unrecognised, and you don't necessarily get that just by looking at superficial numbers like the price to earnings ratio. And again, as always, there's been bad news around these stocks. You can see some bad headlines there. And anytime you start to see bad headlines like that, that's when you sense opportunity. So I want to talk quickly about high insider ownership. It's something that's just become more and more important as my career's gone on. There's so many companies that I find are managed by corporate managers that just don't have any skin in the game whatsoever other than short-term incentives. And we've seen how that's worked out with the banks and all the insurance companies that are going through the Hayne Commission at the moment. So high insider ownership really tries to get away from that. And it's just amazing how different companies are run when the people who run the business have their own wealth in the business. And if you're looking for statistic evidence of this, particularly when you get into an expensive market like we've got today, you want absolutely every tool in the toolbox working for you. You want everything on your side because it's harder and harder to generate value because the price to earnings ratios are already high. And so what this shows you on the chart on the left-hand side is a chart that goes back from 1990 to 2014. And that's the most I could get the data for. And you can see the enormous difference between the returns, so this is the US market, of founder-led companies versus every other company. Now, there's a couple of things to note here. First is the huge impact that the big technology stocks in the US have had because they all tend to be founder-led. So you've got Zuckerberg at Facebook, Netflix, Bezos at Amazon, Google, all these companies are run by their founders still and generally have their wealth invested in the business. Now, just remember this, that chart only goes to 2014. So imagine what that chart looks like with the performance of the FANG stocks with the last 4 or 5 years added as well. It would just be absolutely huge. But here's another key point. It's not just technology stocks. If you have a look at this chart on the right-hand side, you don't need to see the detail there, but what it's telling you is that it's not just technology stocks. It's all stocks. And I could also show you more information for European stocks where there's a lot of dynastical wealth. So there's still a lot of family-controlled industries, a bit like Soul Patts in Australia. And again, it's the exact same phenomenon. And it's just amazing how different people treat their businesses. The Brown brothers at ARB Corporation, for example, how they run their businesses compared to someone else who's got maybe 4 or 5 years in the job, who's not there for the long term, and all they need to do is try and maximise their own bonuses. This next slide shows you what you get when you don't have people running the business with skin in the game. And I reckon you could do a whole university course just on these failures. And all I did was ask my colleague Stephanie to just pick out a few recent ones. And these are the biggest, most well-known companies in Australia: BHP, Rio, AMP. And this was, I think this was done before the worst of the Hayne Commission come out. So it's just chalk and cheese. And I always pick on Mike Smith at ANZ, but to me, he's the perfect example of what I'm absolutely desperate to avoid in the stocks that we own. Mike Smith came into ANZ with support from the board to take ANZ into Asia in a big way. And I actually had a lot of respect for Mike Smith because I thought he said a few things that basically every other bank CEO was too afraid to say. But I never agreed with the strategy. And if you look back through the Intelligent Investor recommendations, you'll always see that we always favoured Commonwealth and Westpac. And I used to get abused all the time on a regular basis that why don't you own ANZ and NAB? You've got to own all four. These are cheaper than CBA and Westpac, which statistically they were. But we just felt it was extremely risky going into Asia. The 4 big banks are a regulatory sanctioned oligopoly. It has huge advantages in Australia that it did not have in Asia. Now, what happened when what we thought was going to happen did happen was there was write-offs, the CEO gets changed, and who got rich out of this? The only person who got rich out of this was Mike Smith, who bought a $14 million house down on the Victorian coast, and he moved down there, and shareholders were left to pick up the pieces. And worst of all, well, maybe not worst of all, but still worse, as if that's not enough, that the new CEO ends up pricing in all his options and bonuses while the share price is down because of all the bad stuff that was done before he got there. And now he's going to get rewarded just for fixing up the business back to what it was before Mike Smith came along. So this is the absolute antithesis of what we're looking for in our businesses and why insider ownership is so important. I'm just going to very quickly take you through a stock that we own in the growth portfolio. Unfortunately, it doesn't pay a dividend, so we can't have it in the income portfolios, but it's just a stock that is really underfollowed at the moment. No one's interested. It's a very small stock, but it categorises all the major things that we're looking for. Oops. So this company is called Frontier Digital Ventures. It's run by a guy called Sean Di Gregorio. He worked at REA Group between 2001 and 2009. And you can see I've taken this slide straight out of the last investor relations pack from Frontier. And normally I don't like seeing CEOs put this sort of slide in because it's essentially promising big future returns. And anytime I start to see that, I tend to think that someone in like a Mike Smith scenario is just trying to maximise their short-term bonuses, and they're not thinking 10 or 15 years ahead with their businesses like I want. So he wasn't responsible for all the performance at REA Group, but he was a senior executive there. And then he was asked to come in and take over iProperty Group. Now, iProperty Group was performing miserably when he came in. You can see the share price there had done nothing. And the guys who work at Capture, who are major shareholders in Frontier now, they were really struggling to find someone to get this business going. Now, Sean was responsible for that huge tick in the share price at iProperty Group. So he understands these real estate classifieds businesses better than anyone. So he made a little bit of money at iProperty, but not enough to put him in the BRW wealth list. And so he's taken his profits from that experience into Frontier. And Frontier is essentially a portfolio of 15 real estate and car classifieds advertising businesses spread across emerging markets. And what he does differently to where we've seen failures with other companies like REA Group going into Italy, for example, is he takes stakes in the businesses and he hires locals to operate them. So he incentivizes them correctly and he gives them the benefit of his experience and makes sure they've got all the resources they need. But they're incentivized to build the business as the way they see fit because they're the guys on the ground who understand their local markets. Now, at the moment, you can buy Frontier, which is one of the very few companies in our portfolio that could be a multi-bagger over the next 5 to 10 years, lower than the price for the cash in the business and its largest investment in Zameen. And Zameen is the Pakistan version of REA Group. And while that probably puts the fear of God into most people, go and have a look at the website, look at the houses for sale on the website. And there's new apartment developments that look just like any other luxury apartment complex going up in Sydney or Melbourne. Pakistan has plenty of money, or there's plenty of money with people in Pakistan, and there's 190 million people in Pakistan. And at the moment, the entire company of Zameen is valued at US $300 million, and Zameen has a 30% stake. So in a country of 26 million or 25 million in Australia, REA Group is valued at about $10 billion. So to me, it doesn't make sense that Zameen is valued at $300 million. I expect that's going to be valued at a lot more over time. And I expect when most of the values being recognised, I expect this will be listed probably on the UK market. And then we'll be, by that time, hopefully the other 13 or 14 investments in the portfolio will be starting to grow like Zameen as well. So this is a big insider ownership where Sean has all his own money on the line. I'm not going to be going to Pakistan to check out the business for myself, but I feel very comfortable with a 3% stake in our portfolio that Sean's doing all the right things. He understands these businesses, and at the moment it's trading at a big discount to the existing assets in the business. So this ticks all the boxes for us. I just want to talk, I'm running out of time and I've barely even got halfway through this, so I'm just going to run through very quickly. But when I came onto Intelligent Investor, one of the things I didn't spend any time looking at was new CEOs coming into a business. And I've just seen situations where more recently so much value has been created where a new person has come into the business, where the business was exactly the same after they added all this value as it was when they came on, but they just pulled the right strings to release that value. And Etsy is a company like eBay in the US. It is specifically for people that specialize in arts and crafts. And so the company earns fees when you put your products up there to buy. And as you can see, everything was going wrong for this company about 12 months ago. Obviously, we don't own this stock in a portfolio. It's a US listed stock. But to me, it's just a perfect example of what we're looking for. So this, the former CEO, up until about 12 or 18 months ago, was driving this business into the ground. It had only been listed for a couple of years. And we all know from eBay's success that the financials for this business should be absolutely brilliant. It's an online company, high free cash flow, huge margins. And what he was doing was spending money on all the wrong things. So the revenue was collapsing at the same time where costs were going bananas. And so you can see there on the slide, the new CEO was announced. Now, obviously, we couldn't predict that, but the share price jumped 30% on that alone. I think Josh Silverman was the guy's name. He'd come from eBay. So he was the perfect guy for the role. Apologies too, there's a mistake in the chart. You can see the dates are wrong down the bottom. They should be going into 2018. And you can see the amazing amount of value that's been created just by this new CEO coming in, stopping the bad spending, spending on the right things. And even more than that, you can see where the share price, if you're looking out to the right-hand side, there's a really big jump on one day, a big straight line heading straight north from about 30 to 44. What he did on that day was he announced price increases. And so you can just see the share price went on a tear again. Now, normally you have to wait for this sort of value to be created over 2, 3, or maybe even 4 or 5 years. But this was done in 12 months, which showed you how good the underlying business was. It was just being horrendously managed. So anytime I see a new CEO coming into a business, that's when I start to pay a lot of attention. And that's part of the reason why AMP's currently in both the growth income portfolio, and that's a stock that I never thought I would own. And I always prided myself at the 10 years in Intelligent Investor that I never even wasted any time looking at. But here it is, things have changed. There's a new CEO, and I think there's value there, which maybe we can talk about in the questions. Normally with a new CEO, particularly in Australia, you see that it usually comes with a recapitalisation. And I always learned when I first came into Intelligent Investor that companies that had to raise money were bad because they couldn't support their business on their own free cash flow, and so they weren't high quality. So I didn't pay a lot of attention to them. But I just remember, some of you may remember Steve Johnson when he launched Forager and we did a national roadshow. He was talking about this company called ServiceStream, and instead of being out there buying the stock, I was more worried about going on and doing my presentation after him. And this is a very similar situation. You saw recapitalisation, so a big dilutive rights issue, but then a new CEO was named, and you can see the huge returns. It's essentially gone up tenfold in the last sort of 5 or 6 years. And now people who are familiar with this CEO called Lee Macgregor are saying he's one of the best CEOs in the country. Now, obviously, it's very hard to recognise that Lee at the time was going to be a wonderful CEO, but there's a lot of things you could have looked at the time. There were some wonderful NBN contracts to show that revenue was going to grow in the future as the NBN was invested in and expanded. You had the new CEO and the balance sheet was fixed. So it had all the ingredients of a potentially good investment that Steve recognised. And I just use this example because it's an Australian example. And again, so anytime I see new CEOs or recapitalisations, rather than ignoring them, saying they have low quality business like I used to, now I see them as really big opportunities. So 2 more quick ones, spin-offs. So this is where usually a large company spins off a smaller division of the business. And what this chart shows, this is just more modern US history, goes back to about 2007. It shows the performance of companies that have been spun off compared to the index. And you can see a huge divergence there. And we've actually got plenty of examples in Australia recently. We had South32, which I think went up 4-fold from the split with BHP. We've seen Wesfarmers and Coles that are just about to split. And we're seeing wealth management businesses that look like coming out of the banks that are potentially spin-offs as well. And TradeMe was actually a spin-off out of Fairfax as well. So again, you've got all this proof that spin-offs really do add value. And sometimes the value is not obvious when you look at the businesses, but you've got such amazing statistical evidence to show that things work out, not just for the company that's been spun off, but also for the parent who's free from this smaller division. They both go on to create great returns. But I just wanted to make this point that in the old days, you used to be able to just buy every single one of these spin-offs and you would have done absolutely brilliantly. But some more recent research shows, you can see on the chart, there's the green line that shows 96 to 2004, so great returns. And you can see from 2005 to 2017, all of a sudden the market's got a bit smarter about these spin-offs and they're recognising the value. So the returns haven't been anywhere near as good. But underneath that blue line, the research actually showed that 6 out of 10 spin-offs didn't just work well, but they worked absolutely brilliantly. So you don't want to buy all 10, but you just want to do your best to try and pick those 10 because you are going to get those returns like the green line. People always ask me, why is it the spin-offs actually work out so well? And the ones that usually work out the best are where a smaller division's got a divisional head that's now the CEO of a brand new listed company. He has the balance sheet to invest in the business. And you can imagine if you were part of a large conglomerate where you're fighting against 4 other divisional heads for money to invest in the business, and you're the smallest, so you're going to have the least impact on everyone's bonuses at the much larger company, you're just not going to get the money to invest and you're not going to be incentivized correctly. And these things change once you're out and you're running your own company with the right balance sheet, and you can start creating all that value that's not obvious by looking at a set of financials that come out instantly from the much larger business where none of the investments have been made, there's no incentives in there for the new CEO. All those things are absent, but you just need to try and recognise a good set of assets and a well-recognised, well-incentivised manager. So this is my last one, hidden assets. These are much harder to find and don't come along very often, but this is always going to be a good source of mispricing. This company is 360 Capital. I've been trying to add it to the portfolios. I've only got a really small piece. It's hard to get a hold of, so I'd love to be able to tell you it's a great position in the portfolio, but it's not. But I just do want to quickly mention it because it's exactly the sort of thing where we hope to find more value over the next 5 or 10 years. This company is called 360 Capital, and it's got the ticker TGP. And you can see on the chart down the left-hand side, I was actually an investor in this stock, and I rode that little bit coming out of the GFC. And the reason I owned it was because there was a guy called Tony Pitt who owns about a quarter of the shares, and he come in, took control of this business. This is what I call a B-grade REIT, so a real estate investment trust, and it's owned B-grade properties, so not the giant buildings you see in the middle of Sydney or Melbourne, but just very small buildings that might be worth $30 or $40 million around suburbia. And you remember then all the A-REITs were trading at big discounts to their net tangible assets. And he said, I'm going to come in and I'm going to sell off all these individual assets one by one. I'm going to get the occupancy up, get the rents up, then sell them, and I'm going to close that gap to NTA, which he absolutely did. And then in all my wisdom, I sold my shares, locked in my little gain, and went off to buy other stocks. And so you can see then that I missed out on that huge run from March 2013 to March 2015. And what Tony did then was he just bought another whole bunch of assets. He managed them extremely well. And when he realised the value, he would sell them, lock that in, and then buy the next property. Now, more recently, this business has changed a little bit. It's essentially become a cash box. And the future for this business is that he's very aware of where we are in the real estate cycle. So we're very much towards the end of it. And he's very worried. He doesn't want to put equity into investments where you've got no protection. What he's doing now is looking for small projects, say $13, $15 million, and providing debt, which has got a lot more covenants around the debts. So Tony's a very smart operator. He wants that protection because he knows things are going to be a lot tougher over the next 5 years than they have been over the last 5 years. So he wants that protection. And what this slide shows you is that there's a real opportunity being created at the moment, and the returns for lending in this market have got much, much higher because the Australian banks have been slowing their lending, forced by the regulators, and been pulling out of these markets, which has created a great opportunity for other companies to come in and take that market share. So basically you're paying net tangible assets for essentially what is a cash box at the moment, but with a very clear strategy. But here's the hidden asset in the business, and you don't need to see the detail there, but it's basically a platform to raise money to invest alongside 360 Capital in these projects. And so if you can imagine, this is essentially like a funds management business where people pay fees to come in and out, and 360 Capital generates performance fees depending on how the project goes. And so at the moment, we're paying absolutely nothing for this. And this business has already raised $111 million for projects this year. So I don't know whether this will be worth zero in the future, but I can also imagine a case where it's potentially worth hundreds of millions of dollars, depending on how the projects go and whether happy clients come back and do more projects and whether the projects expand in scope and size. But the key point is you're paying absolutely nothing for it, so you can't lose. And so these are the sorts of situations I'm looking for. They're hard to find, but when we do find them, we want to make sure we maximise them because we just can't rely on price to earnings ratios increasing to generate our returns from here. So that's the end of the formal presentation. There's just we'll do our Q&A now, and there's just a few websites there where if you want to get more information about the funds and potentially invest, you can do that. But for now, Sophie, we've got questions.
Okay, great. Thanks, Nathan. We have had a few come through. So we've got Donald. He asks, in your article from the 12th of November, you mentioned James Hardie as a new addition to the income portfolio in October, as it is well placed to benefit from the long-term growth in the US housing market. It appeared in the portfolio for about a month, but is no longer there. Is it in the portfolio or not?
So I fully expected this question, and we've had a couple of emails about it. So the investment case for James Hardie was, in my former role, there was a company that I just loved called NVR. It's a home builder, and it's completely unlike any other home builder that I've ever seen. The company actually went broke in the early 90s, and the people who ran this business said, how can we come up with a business model that means that every time there's a cyclical downturn in the real estate industry that we don't go broke? And what they come up with was that instead of buying a huge land bank and having a huge amount of debt on the balance sheet to go with it, and obviously risking the business every time there's a property downturn, what they did was they took and paid an option premium, so say 5 to 10% in the land, and therefore they didn't have to hold all this debt against land. They just had an option premium that they paid, and when they were finally ready to develop the land, they would pay in full for the land, and they'll develop the property and sell the property. So therefore, it's actually a very high free cash flow business, and it's bought back 80% of its shares over the last 20 years. It's been an absolute phenomenal investment. And one of the reasons I really liked NVR is because in the US, and I apologise, this is a long way around to answering your question, but NVR has been a hugely successful company. The returns in the last 10 to 20 years are in the thousands of %. And the real big upside for that company at the moment is that in the US, they're currently new home building starts around 1.2 to 1.3 million. The long-term average has been around at least 1.4 million. So even after 10 years since the GFC, we still haven't got back to the long-term average. But if you have a look at a chart, and I will produce these in the quarterly for you to explain the situation, the millennial population coming through America at the moment is the single largest population cohort ever in US history. It is massive. And as Warren Buffett is fond of pointing out, they're going to do all the same sorts of things that populations, their fathers and parents have done and their grandparents, and that is have families and have kids. And when that happens, and you include obsolescence for the existing US housing stock, which in some parts is very old, I believe you're going to get to 1.6 million housing starts per year, if not more. And so I was looking for an opportunity like NVR in Australia, and I got a bit excited about James Hardie because the share price had come down about 20 or 25%. And I thought there was a decent margin of safety, even though James Hardie is cyclical like NVR, but it doesn't have a balance sheet like NVR. So it wasn't going to be a situation where if the share price got really cheap, it was going to buy back a whole heap of shares. So in that sense, it was very different. And so I bought the stock, and then we got the results, and the share price fell around, I think it was around 15% on the day, and was down about 10% from where I bought it. And a couple of things in there. One, the US housing market is slowing much faster than anyone realised at the moment, and I was aware of that, so that's not the big issue I've got. And I'll talk about another investment I've made in a second that is still bullish on that theme. But if you saw the costs coming through that business, and James Hardie had actually done better than most to put the higher costs through higher prices for its product. But we're talking about a 20% increase in freight, and part of that was the high oil price, and a 24% increase in pulp. Now, everyone was aware that these costs were higher than what they have been traditionally. But where I believe I've got it wrong, and only time will tell, is that a lot of people think that this is just cyclical. So oil's up, so freight is up, and pulp is up. As well, but there's a whole lot. But that week, there was about 5 or 6 companies that I follow in the US that all announced similar situations where the stock prices were down 15 to 20% on the day, and they're all blaming the same thing: higher costs. The problem with freight is that they can't find enough drivers. There's just not enough skilled people now in the US to meet, I guess, the sales growth of companies and demand. And the cost to hire people now is going up. We've seen the first wages growth in the US in over a decade. So where I changed my mind is I actually believe that these costs are not so cyclical and going to go down, although the oil price has been falling, so maybe that's going to help in the short term. But I actually think we're starting to see the first signs of entrenched inflation that we have not seen in decades. And I find it very weird that we see official statistics for the US and Australia showing very low inflation. And yet, when I look at the own costs in my own life, with private healthcare going up 6% a year, my rent going up 3 or 4% a year, you name it. And then I look at the individual companies we own, and I'm seeing the costs going up in the individual businesses. And I just don't think this is a short-term situation. I think this is actually going to be drawn out. So I believe I've got the margins. I overestimated the margins. And so I believe I'd made a mistake, and I corrected that mistake as quick as I could. And it cost the funds around 30 or 35 basis points. But the other thing I've learned through history is that profit downgrades don't usually come in singles. And for anyone that followed the QBE recommendation when I was at Intelligent Investor, which passed through Steve Johnson, Greg Hoffman, and myself, and I stuck with that business as long as I could, and it ruined about 3 long weekends that I took announcing profit downgrades. And I just continually gave the company the benefit of the doubt that it's not something I'm prepared to give anymore. So when I recognise I've made a mistake, I'm going to correct it as fast as I can. And anytime I see a downgrade in profits, I know that it's a bit like the cockroaches in the kitchen. There's usually more than one. And not always, it's not always the case I'm going to sell it instantly, but in this case, I felt like I'd overestimated the profit margins, and so I sold the stock.
Great. Okay, thank you. So another question, is the plan with Frontier to IPO or to do a trade sale of the underlying holdings?
Fantastic question, and I think this is one of the most important parts around the business model, because it's a really unique situation where, let's say, let's put ourselves in Sean's shoes, and we've got these stakes in 15 different businesses where we don't really control the business. We've essentially got 30 or 25 or 40% stakes in these smaller businesses, so we don't necessarily control them. And so the people on the ground who are running these businesses could do all sorts of things to ruin the value, or they may well have different ideas about realising the value, the full value of the business in terms of getting Frontier's investment out of it. So if you look in the slide deck for Frontier and you look on the ASX announcements, they go through about 7 or 8 different ways that they can get out. They can potentially sell their stake to someone else in the business or just a third party. They could potentially list the business if it's big enough. As Zameen is the only one that's currently big enough where I feel a listing is probably the best way to get the full value for that in time. But you don't want to sell these businesses too early, because at the moment the revenues for Zameen are doubling every year, and it's making an extraordinary amount of money, not just on display advertising, but being a trusted seller of apartments or a trusted place to transact to sell apartments. So in a sense, Zameen's actually more cyclical than REA Group is, because REA Group is just 100% advertising. And at the moment, Frontier is taking, or Zameen is taking a clip on apartment sales. But it's actually not a bad strategy either, because it has, I guess, a feather in its cap that REA Group doesn't have, that people have plenty of other ways to transact real estate in Australia where they feel confident that it's going to be fine, whereas that trust doesn't exist in these emerging markets. So if Zameen and all the other stocks in or investments in Frontier's portfolio can become that trusted source, then that's a huge opportunity for those companies. So I think Zameen will eventually be listed when the time is right. But with the other smaller situations, it just depends. But I know there's a number of different ways to realise that value, and I'm sure Sean will pick the one that realises the most value. Great question, thank you.
Okay, so John asks, you've mentioned spin-offs, new CEOs, etc., but what are your thoughts on buybacks? Is this an indicator you should have a look at a business? I remember CSL doing a buyback a few years ago when it looked expensive at the time, and now the share price is a lot higher.
Okay, so great question, and I'm going to give another long-winded answer here because I just like to tell these stories, because I just find they stick in your mind more than talking about the details of any individual stocks. So see, that buyback that CSL did was basically after an acquisition that the CEO, Brian McNamee, was orchestrating from his hospital bed when he was getting treated for testicular cancer. And I actually think Brian McNamee is one of the best, if not the best, CEO an Australian company's ever had. And what he did was he raised money from shareholders and tried to make this deal. I think it was Talicris, and the regulators said, no, it's going to give you too much market power, and we're not going to, basically we're going to give you a hard time, we're not going to probably let you take it over. Now, having raised the money from shareholders, which was conservative because most companies just raise debt and put the business at risk when they make these acquisitions, Brian McNamee or any other CEO, just about any other CEO, I guarantee would have found another stupid use for that money. They would have just had the money and said, we've got it now, let's go and spend it. And Brian McNamee took the absolute opposite opinion, which was the right one, and said, this is shareholders' money, I'm going to return it to shareholders, and he did it through the buyback. So that, in that sense, that buyback was very unique and it made sense at the time. But you're absolutely cottoning onto something that is a contrarian indicator of where we are in the market, in that the amount of buybacks, particularly in the US, where they don't pay higher dividends, has been just absolutely huge over the past few years. And usually that's a sign you're getting to the top of the market. So I actually look at large share buybacks normally as a contrarian indicator of a lack of value, or particularly in those stocks. And normally we find that shares are bought back at the absolute worst possible time by CEOs and the boards, when the stock price is as high as it ever gets, when the company is flush with cash, and usually when the time is to add the most value, which is at the bottom of the cycle, you see none of these companies buying back stock. They're worried about their balance sheet because they've wrecked it in the good times because they spent too much on buybacks that didn't add any value. And you're absolutely right to focus on whether a buyback adds value, and very few of them do. And it's a bit like acquisitions. I think it's about 30% of acquisitions ever add value, and buybacks are probably about the same.
Okay, great. We've got another question. CC, I think this is in relation to the share recommendations. What is your perspective on buying holds, i.e. many of the stocks in the funds are currently holds, versus building your own portfolio from only the II buys? How would you think the returns would compare from both approaches?
Excellent question. And the best way to have a look at this is if you look back through the recommendations report, which is audited at Intelligent Investor. I haven't looked at the most recent one, but it used to be a case where our long-term buys basically did as well as our buys. I think it was just marginal, the difference between them. And what that said is we were always too conservative with our valuations, and there's been a whole litany of great quality stocks that we've sold way too early. And it's always a problem with being a value investor. You're trying to be careful about the valuation, have a margin of safety. But the lessons really are when you buy great qualities is try not to sell them if you don't have to, and as long as the valuation is somewhat reasonable. In terms of what the best thing is to do, at the moment, there's a bunch of, just to give you an example, there's a handful of companies in the portfolios that I manage that are holds on the recommendation list with Intelligent Investor. And so one I bought recently is ResMed, which doesn't look particularly cheap at 24 times earnings, but we've followed this company forever and a day. It's a wonderful company. It's growing extremely quickly, and it's exactly the sort of business that I want to make up the core of our portfolios. There's plenty of growth to come over the next 10 or 20 years as long as there's no technological upsets to the business. Has huge profit margins, and the OSA business or the sleep apnea business, I think I can't remember the numbers offhand, but basically it's only like 1 or 2 out of 10 people in the world have actually been diagnosed and getting treated. So there's all these untreated people, and with obesity, the amount of people suffering from sleep apnea grows every year, and particularly with emerging markets as they start to eat worse food and junk food and all the rest, they're going to be huge markets in China and everywhere else as well. So I'm more than happy to pay 24 times earnings for ResMed. Obviously, it's a hold at Intelligent Investor. It's hard to put a buy on a stock with a starting price to earnings ratio that high. But when I think about investments, I'm thinking about the next 5 to 10 years. I'm not thinking about the next 6 months or the next 18 months. And I really want to own great quality businesses, and there just aren't that many of them. So if I can buy them at that sort of multiple, and as long as the growth comes through over the next 10 years, we're going to do really well. So I guess that gives you a bit of a clue of how I think about these stocks. But when you buy, so just don't always look at the whole recommendations and think they not necessarily buy ideas, because we tend to undervalue the really high quality businesses at Intelligent Investor. It's something we fight hard to do. But I remember I had a friend look at Berkshire Hathaway one day, and I said, what was the price to book ratio you could have paid for this like 30 or 40 years ago? So at the moment, Berkshire Hathaway, Warren Buffett's company, trades for around 1.2, 1.3 book value. And so we argue about should you buy it, is it cheap or not, basically around this price to book measure. Well, I think the equation we come up with is you could have paid something like 60 times book value for this company 40 years ago, and you would have made a 10% return, which is absolutely a phenomenal statistic. But the question is, can you find someone that can produce as much value over 30 or 40 years as Warren Buffett? So I'm not making that sort of equation with ResMed, but I think when the business is growing at 15 or 20% per year and it's got so much growth in front of it, I think we'll do well, even though it doesn't look statistically cheap currently.
Okay. And last question. Asia is looking cheap as a region in general. Is there any way for the portfolios to take advantage of this? Is there even a case for the portfolios to buy an ETF like IAA?
So I'm not completely familiar with the holdings in the ETF, but I'll just check the China exposure because it might be fairly small. On just the China, I just say in China generally because that's where the biggest stocks are and the ones I'm most familiar with in Asia. I actually think there's a number of them, like they're just absolutely cheap. And if you're interested in some of the ideas there, just go and have a read of Platinum's quarterly last quarter, and they talk about there's businesses they're trading on single-digit price to earnings ratios with a return on equity in the 30% range. with enormous growth clearly in front of them over the next 10 or 20 years. So if I was an investor sitting here today and I could only invest in one spot today, China would be my market. Clearly, that's general advice, not to be taken personally, because it is a very volatile market. But that volatility is something that I absolutely love, because if you don't have that volatility, you just don't get the chance to buy these great businesses at cheap valuations. So I think China's a great place to be looking. In terms of how we can get some exposure in the funds and the growth and income portfolios, it's much more difficult because the companies that tend to have a little bit of exposure there, if I take Blackmores, for example, they're typically recognised as excellent businesses, and they just haven't been caught in the downdraft that all the Chinese stocks have. The Chinese stocks have essentially down by 25 or 30% across the board. And the reason is because quantitative tightening in the US is just sucking in a lot of money that's been out in China and other emerging markets back towards the US, because now interest rates are going up and safer investments or high quality investments are providing us somewhat of a yield in a way they haven't since the GFC. Frontier is probably a stock that's been caught up a little bit in that as well. I think it's just underfollowed, more importantly. But I'm finding it hard to find an angle for our portfolios to buy at a decent price. But companies like ResMed, and we don't own CSL at the moment, but there's all these sorts of companies that will benefit from having that China exposure over time. It's just a very hard period trying to buy them at an attractive price. And as much as I love CSL, and no one loves it more than I do, given I was the first analyst at II to recommend it, did far better than I ever imagined. But I just can't pull the trigger at 37 times earnings. We're seeing price earnings ratios compress at the moment. So when I think about a company like CSL trading at 37 times earnings with a little bit of Asian exposure, and I compare that to a Ping An, which is widely regarded as one of the best insurance businesses in the world, that you could buy for around 12 times earnings. It's been growing at 20% a year and will probably grow at 10 to 15% a year for the next 20 years. To me, it's a no-brainer which investment I prefer.
Okay, well, thank you, Nathan. That hopefully answers most of the questions. If you do have any further questions, please feel free to email us at support@investsmart.com.au. Well, thanks, Nathan. It's been great.
Thanks, Sophie.